Ladies and gentlemen, good morning to all of you. It's a great pleasure for me to be here to share with you a few thoughts about mutual fund investments. It is an even greater pleasure because this event has been organized by people who are very close to me, the directors of Simplest Financial Consultancy, with whom many of you, I think all of you, are associated in some way or the other. My friend Deepak introduced me in a very flattering manner. I sincerely hope I deserve the various qualities that were attributed to me. But I also wish to pay tribute, two tributes in fact. The first tribute I would like to pay to all of you, because in these days, investors are incapable, I'm sorry to say, of choosing between advisors and salespeople. You have chosen advisors. So it should be I who applaud you. You are with a very good firm, and I know a little bit of what is happening in Simplest. And I can straight away tell you that great improvements will be seen by all of you in the coming months, perhaps the year. So with this very brief introduction, let me talk to you a little bit about a few areas of mutual fund investment where I see value, and I have seen genuine value being conveyed to mutual fund investors in my 27-year career in the financial services industry. My focus today will be threefold, but these three folds are related to each other. The first, in times of increasing complexity, and I would say needless complexity, I will be focusing on simplicity. Warren Buffett said it beautifully. Investing is simple, but not easy. It is very simple. So long as we stick to the path of simplicity, we are unlikely to run into trouble in our investments. And simplicity is just one side of the coin. The second side is common sense. Generally, you will find that anything based on common sense happens to be simple. And my third focus will be investor empowerment. In fact, this would be my main focus. Have you seen this board here? The name Simplest, simplicity, one and the same. But going below Simplest, educating, empowering, enlightening investors. The same theme that I'm going to use today is also being used by the firm that has invited you here. Why I'm talking about empowerment is, very few of us as investors know the kind of power that we have in our hands when we deal with our own investments. We have a very wrong notion of thinking that financial advisors, investment advisors, are some great people, some great prophets who have all the knowledge, all the expertise. We have nothing. Wrong. Some of the finest investors I have seen are illiterate. I have one in Mangalore. He is a temple priest. Till recently, till some time back, he could not even sign his name. He used to use his thumb impression. Then his children, who were educated, compelled him to at least learn to write his name. But he had an equity investment portfolio of 3 crore rupees. And I have seen PhDs in economics and finance who have lost money in speculation in the stock exchange. There is a lot of power in your hands which has nothing to do with mathematics or finance or educational levels. It has a lot to do with simplicity, common sense. So that is going to be my theme today, and as I progress in today's presentation, from time to time I will be pointing out to you the areas in which you have the power. And once you realize those areas and you realize that you have the power, you have to use that power and you have to do something else. You have to ensure that you do not lose that power. Use the power, do not lose the power. This is going to be the thrust of my whole presentation this morning. One picture that you are going to see and one individual that you are going to come across repeatedly in my presentation today is John Bogle. So let me introduce him right now. John Bogle is the inventor of the no-load, low-cost index fund. He launched this in 1976. Let me clarify, when I say inventor, the concept of indexing existed much before 1976. One or two people had tried their hands at index investing before that, but they had not succeeded. He was the first to launch an index fund which succeeded. The Vanguard S&P 500 index fund, which is even today one of the largest mutual funds in the world. He established a mutual fund called Vanguard Mutual Fund, today the second largest mutual fund in the world. Very ethical fund, investor-centric, investor-oriented. And for me, John Bogle is the ultimate authority on mutual fund investment. Let us see what he says and whether he talks anything different from what I am trying to talk. Intelligent investing turns out to be little more than common sense and sound reason. So the greatest authority on mutual fund investing in the world today is telling you the same thing. Intelligent investing turns out to be little more than common sense and sound reason. For a moment, although we may be mutual fund investors, let us focus on what is a mutual fund, and let us see whether our understanding of the concept of a mutual fund needs to be revised a little bit. You see this slide here. You will also see the same slide appearing a little later, after I have put things in perspective. And then let us ask ourselves whether we have a new understanding. A mutual fund is a common pool of money to which investors contribute for investment in accordance with a stated objective. You may have these petty little pawnbrokers or finance shops on the roadside, which will probably offer you 20 or 24% interest. And some people may be greedy enough to put their money there. That is also a common pool of money because investment is collected from a large number of people. But you do not know how they are using that money. There is no stated objective. In a mutual fund, you have excellent regulation, not just in India, but world over. And I can tell you that where regulation in India is concerned, we are second to none. Some of the best regulatory practices have been implemented for mutual funds. One or two of them may be controversial, but overall, SEBI has done much more good than bad. The stated objective is very important. And now we will focus on this word objective because this definition does not need any explanation. A common pool of money, lot of people contribute, the investment takes place in accordance with a certain objective. But we should understand this word objective correctly. Only then will we understand what a mutual fund is. Therefore, for 2 minutes, let me dwell on a few fundamentals of investment itself. The first fundamental, all investment must form part of a plan. Very often, we will wake up only when we have what we consider to be excess money in our savings account. Moment we have excess money in our savings account, I think I need 50,000 rupees, but I happen to realize that there is 1,75,000 rupees there. So according to me, the excess is 1,25,000 rupees. I ring up my friendly neighborhood small savings agent, or even without ringing up, an insurance salesman will turn up at my door. And so, when we are looking at investment, if it is just a question of dumping our excess somewhere, I'm afraid to say that is not investment. Every investment must be part of a well-considered plan. And also remember, it is never too late to plan. I have helped people start planning when they were already retired. It is absolutely correct that investment plans will be very effective if started early. There is no doubt about that. There is no way we can substitute that. That does not mean if I happen to wake up to the need for investment planning at the age of 50, I must say it is too late and sit quietly. No. Somebody who is 50 may live to 90. People living into their 80s are very common today. Nothing prevents you from starting at 50. You have got 40 years ahead of you. So it is never too late to plan. Investment planning is so important that having a plan without the money to invest is better than having the money to invest without a plan. The language may sound nice, but the thought behind it is very, very important. When I address students, many times they say, yes, investment planning, but we are not earning anything. No problem. Nothing prevents you from having a plan. Because you are not earning today, does not mean you will not be earning tomorrow. And tomorrow when you start earning, when there is an inflow of money, then that money will be invested correctly. Whereas, if there is no plan, when the money comes, the money will be, I'm sorry to use the term, dumped. Dumping is not investing. And when we formulate our investment plans, we have two categories of concepts to apply. One is investment principles, other is investment plans. The principles of investment do not change. They remain constant. Plans will always be different because plans are implemented for an individual. Each individual case is different. Investment principles are constant, investment plans are unique. From the constant principles, we formulate unique plans. Let me give you an example to understand this. Let us say there are two families in Bangalore. Each family is a virtual carbon copy of the other, a replica of the other. Husband, wife, two children, husband, wife, two children. Both are working, both husband and wife are working in family B also. The children are of the same age, attending roughly the same educational institutions. Going further, the lifestyles of the two families are more or less the same. They are earning roughly the same amount, they are spending roughly the same amount. You would be tempted to think that a financial plan that fits one family should fit the other. But if in the case of family A, they have either had the good fortune of inheriting a house or an apartment, or already having purchased an apartment, but family B has not done that, immediately, although the two families appear to be a replica of each other, there is a fundamental difference. When the advisor is sitting and advising family B, the purchase of an apartment or a house may be a priority here. It may not at all be a priority for family A. All of us are unique individuals. Our situations are unique. Our plans have to be unique. But the principles from which we derive those plans are constant, which I will explain in a minute. Now, this is the first slide where I can show you both common sense, simplicity, as well as empowerment. When we are confronted with the huge mechanism that is the financial services industry, the part of the financial services industry that we come across is generally the marketing arm of the financial services industry. A lot of salespeople, and salespeople are marketing products. Products are the least important part. The most important part, the foundation, if I am to compare this to a building, the foundation is always the plan. The plan and the product. The product is only a means to the end. It is not the end, it is not the objective. The objective is the plan. Now, when you want to graduate and you want to implement your plan using products, the process that you follow is where the investment advisor should step in. This is the role of the investment advisor. So the first way you can empower yourself is, the next time some friendly neighborhood salesperson approaches you, try to think back. Is he advising me on my investment plan? Are his questions the type that will help him draft a financial plan for me? Or is his whole focus on selling me a product? If the answer is product, you are dealing with a salesperson. If somebody is talking to you about various aspects of a financial plan, then he is an advisor. So you can safeguard yourself by arriving at this basic conclusion of whether somebody is an advisor or a salesperson. Of course, in your case, it may be a little easy because you are, I think, already in touch with a company of advisors. What is personal investment planning? It is nothing but the arrangement of your financial affairs to actualize, to fulfill certain objectives. Now let me relate this slide to the definition of the mutual fund. A common pool of money to which investors contribute for investment in accordance with a stated objective. And if you see the last word here, you are once again looking at objectives. If you want to be successful in mutual fund investment, the objectives of the mutual fund product or plan should match with the objectives of investment. If they match, you are into a good product. If they do not match, you must not go in for that product. I will give you some more examples to explain this, but before that, let us look now at the objectives not of mutual fund investment, but the objectives of investment itself. It is very simple. There are just 4 objectives. The first objective is to increase wealth and not just income. A lot of us focus on income. We earn salaries, we have a surplus, we put it in bank fixed deposits. But bank fixed deposits are not wealth generating investments. They are only at best income generating investments. When we are already earning income, it would be very foolish to put our money in further income generating investments. We must, during our active, productive working lives, focus on the building of wealth. The second is, when we earn income, we must focus on tax efficiency. 10% bank fixed deposit versus 8% PPF. If I am to choose between this, if I am working and earning enough to take care of my expenses, and if I am in the 30% tax bracket, we will forget surcharge. If I am in the 30% tax bracket, my 10% bank deposit is not a 10% bank deposit. It is a 7% bank deposit because 3 rupees out of 10 are going to the government. Now when I compare the post-tax rate, 7% on the bank deposit, 8% on the PPF. PPF is giving me higher because PPF is tax-free. Public Provident Fund interest is tax-free without limit. This is what I mean by focusing on tax-efficient income. The bottom line is important, not what you see on your fixed deposit receipt, not the 10%. What am I getting net, like a businessman does not look at gross profit. It is of no relevance, except in your profit and loss account or balance sheet. Net profit is important, the bottom line. Third is to maintain the highest possible liquidity in investments. Always maintain liquidity. It's very simple. You have got 3 choices. 8% government bond, 8% post office monthly income scheme, 8% bank fixed deposit. 8% government bond, you cannot withdraw before 3 years. 8% post office monthly income scheme, you cannot withdraw before 1 year. 8% bank fixed deposit, you can put today, withdraw tomorrow. If all are giving the same rate of return and all have the same taxability, you must always graduate from the less liquid to the more liquid. Liquidity is very important. And finally, safety is important. The objectives of investment are so important that there is this beautiful saying which puts things in perspective. An investor without investment objectives is like a traveler without a destination. If you are a traveler without a destination, you cannot wear the badge of traveler. At the best, I am a wanderer. I may be a wanderer, not a traveler. That is the difference. A wanderer is a speculator. A traveler is an investor, because a traveler is traveling towards a destination. A beautiful saying to put things in perspective. Now, going back to the fourth objective of personal investment planning, there are a few risk management tools available to each and every investor, which without any difficulty can be used to enhance the safety of your investments. And the first tool is diversification. The second is the setting of investment time horizons. When we look at diversification, there is always a very famous saying in investment. There is no such thing as a free lunch. Don't be afraid. Today's lunch is free. But I will come back and say that there is no such thing as a free lunch in the investment business. If something is being projected as free, you will have to pay for it somewhere else in some fine print. It is like I always tell my wife, when it is advertised there, 50% discount in a clothing shop, you will find that there is a 50% discount, but only on handkerchiefs. Or in a shoe shop, the 50% discount will be there, but on probably shoelaces, not on the product you want to buy. But there is in investment, the closest thing approaching a free lunch is diversification. If you do not diversify, then you have only yourself to blame if you encounter above average losses. Time horizons is, just like all of us have a time horizon which lasts from our birth to our death, investments also have a time horizon. There is an optimum period for which you must invest. And we confuse these time horizons. We confuse between short-term investments and long-term investments. If you look at the roughly 60, 70 years that have passed since the 1940s, 1950s in India, in real estate, you'll find that time horizons generally are 10 years. Boom and bust cycles in real estate markets take place generally once in 10 years. The implication is that if I put money into real estate, that should be money that I can afford to sink there for 10 years. Similarly, many of us are surprised when we learn that equity markets have a history of 400 years. I have asked this question to many people, including students. And students say equity markets may be 100 years, maybe 80 years. Some people even say 40 or 50 years. 1602, the Dutch East India Company was the first company to be formed. And in the same year, or 1 or 2 years later, early 1600s, the Amsterdam Stock Exchange was the first stock exchange in the world. 400 years of stock market history has a lot to teach us. And one thing it teaches us is that across geographies, a boom and recession cycle in the stock market takes place once in 5 years. The implication is, if I am putting money into any stock market investment or any stock market oriented investment, that money must be money I can afford to block for at least 5 years. Equity is not a short-term thing. It is not a short-term thing. And I said at least 5 years. It doesn't mean it suddenly matures after 5 years. I have had investors who have invested for 4 decades, 5 decades. They have not sold. Today they are living only off dividends. only of dividends. They are not bothered about whether markets go up or down. These are the true great investors in the stock market. And they do not brag about it like the speculators. They will not talk about their investments at cocktail parties. Systematic investment. I'm going to talk about this at length a little later. Very important, recurring investment. And then reviews. Once in a way, you must review your investments. File your papers correctly in chronological order and review the investments once in a way. So, when we look back at the fundamentals of investment, let me summarize. All investment must form part of a plan. The plan must be to achieve 4 objectives. The increase of wealth, the earning of the maximum possible tax efficient income, the maintenance of the highest possible liquidity in your investments, and the ensuring of the safety of your investments. And when we come to safety, you have 4 beautiful free risk management tools available to all investors: diversification, understanding what is short-term and what is long-term in investment, systematic investment, reviews. Ram Piparia, whom I had the privilege of associating with more than 2 decades ago, a very fine investment advisor, he had written a beautiful book called Bulls, Bears and Blue Chips. He had a simple method for remembering these 4 objectives of investment. The increase of wealth, he denoted with the letter A for appreciation. The earning of tax efficient income, he denoted with the letter I. Liquidity, his term for it was marketability. And security or safety, it was S, aims. Appreciation, income, marketability, security. So, remembering this and using this, you can analyze any investment. It's not difficult. Any investment can be analyzed. The aims of appreciation, income, marketability, security. It is that simple. Yogi Berra was an American major basketball player, and he was very famous for coming out with malapropisms. That is, he used to get tongue-tied, but there used to be some sense in what he used to say ultimately. One of his sayings was that you must always attend other people's funerals, otherwise they will not attend yours. From the investment point of view, he said, if you don't know where you're going, you'll wind up somewhere else. You'll be a wanderer. Now we come back to our definition of mutual funds, and let us ask ourselves whether we are beginning to understand mutual funds in a little different way. A common pool of money to which investors contribute for investment in accordance with a stated objective. But now when we are using the word objective, when we are using the word investment, let us understand that we are using it in the terms of the aims: appreciation, income, marketability, security. We are using it in the terms of the risk management tools, diversification, time horizons, systematic investment reviews. So to give you an example, if a mutual fund tomorrow comes out with what is called a sector fund, technology only, banking sector fund, only banking, infrastructure fund, thematic, let the mutual fund come out with it. Should you invest in it? Clear answer is no, because it militates against the risk management tool of diversification. So this is how we have to understand and analyze a good investment. That is why you will find that the ethical advisors will never put your money into thematic funds, sector funds. On the contrary, if your money is there, they will tell you, get out of this at the earliest, shift to a well-diversified fund. Let us proceed. If you take the trouble of familiarizing yourself with the investment principles and invest accordingly, this is what will happen to you. Frank Nettie is an expert on retirement planning, a very important part of financial planning. He says, sound investment will decrease the time during which you work for money and increase the time during which money will work for you. A beautiful saying. And with this, let us get into the main session today, the 6 areas of mutual fund investing where I see value. And the first area is parking and emergency funding. What is parking? What is emergency funding? Parking is when you need to keep money, generally a significant amount of money, for a totally uncertain period of time. Example, I have sold a property of 1 crore rupees. With this money, I have received the money, the deal is over, the registration has taken place, the money is in my savings account. With this money, I intend to purchase another real estate property. Now, purchasing real estate property is not like walking into a supermarket and buying something and getting it built. You may get the desired property, if you're lucky, in a week or two. Sometimes you may not get it for several months. But when you happen upon a good property, your money should be ready to pay for it. That is parking. Uncertain period totally. Emergency funding is something a little different. It is a concept in financial planning where you create your own private insurance policy. I will come to emergency funding a little later, but before that, whether it is parking or whether it is emergency funding, where mutual funds are concerned, you must use any one of these. Either a liquid fund, or a short-term floating rate fund, or a short-term fund. Nothing more than this. These are the category of funds that carry the highest safety and the highest liquidity. And this is very important. More and more, we find people enamored of equity funds. Mutual funds mean equity. Equity means stock market. There is a very large segment of debt mutual funds. And many times these debt mutual funds are very good. They give you a very comfortable, unexciting investment experience. It is good not to get excited in investment. Excitement and expenses are an investor's greatest losses. This is what Warren Buffett said. Excitement and expenses. You have to approach mutual fund with cold logic and common sense. At least that is what I'm trying to do this morning. So this is what you use, the safest and the most liquid part of mutual funds. And a little bit about emergency funding, which is one of the basic legs of financial planning. Every family needs a minimum cash buffer to meet emergencies. You need a shock absorber. Many times there are many emergencies that can be handled to a very great extent just by money. How much should you build to? Different people have different opinions. My opinion is that every family must have 12 months of normal living expenses in an emergency fund. In fact, my simple formula for the emergency fund is 12 months of normal living expenses rounded off to the next higher rupees 1 lakh. Example, 40,000 rupees per month is my normal living expense. 40,000 into 12, 4.8 lakhs. Round off to the next higher, 1 lakh, 5 lakhs is your emergency fund. I can give you any number of examples to show the importance and need of an emergency fund. A family of 3 people whom I was advising in Mangalore. A couple in their 60s, late 60s, and the sister of the man. She was suffering from very bad arthritis, was confined to a wheelchair. In their case, there was no medical insurance. When I examined the whole case, I'm talking about 12 years back, I found that they don't need 1 year's normal living expenses, they need 3 years' normal living expenses. Their normal living expenses at that time were about 15,000 rupees a month in Mangalore. Into 3 was about 1.8 lakhs. Into 3 years, 5.4 lakhs. 6 lakhs was the emergency fund I recommended. From time to time, they used to see me. Nothing happened for 2 years, and they used to say, money is lying there. Yes, it is safe, but very low rate of return. I used to tell them, my advice is keep it. And they listened to me, although they used to grumble. Suddenly, within 3 months, 2 things happened. The man had to undergo a multiple bypass surgery. And just as he was recovering, his sister, who was confined to the wheelchair, had a fall and needed a hip replacement. Close to 4 lakh rupees had to be spent in a period of 3 months. They didn't have to think. They didn't have to withdraw from existing investments. They could just write checks. And the same family, 6 months later, they had come for a review of their investments to me. The same people who were grumbling about the size of the emergency fund, do you know the first question they asked when they sat down in their chairs? You know, we had that emergency fund, we started with 6 lakhs, of course it went to about 7 lakhs, then we have withdrawn 4 lakhs from it, now there is only 3 lakhs left. Should we not build it back to 6 lakhs or 7 lakhs? The same people who are grumbling about the emergency fund now realized the emergency fund. Why? Because the emergency happened. Instead of trying to learn from our own mistakes, we must cultivate the habit of trying to learn from other people's mistakes, from other people's experiences. Experience is a very harsh teacher. It gives the test first and the lesson afterwards. That is the saying about emergency. The test first, the lesson afterwards. Not like normal education where first the lesson, then the exam. No. So it's always better to learn from other people's experiences. Emergency funds, of course, must be in very liquid, very safe investments. Let me give you what, in my opinion, using mutual funds is the best strategy for emergency funds. Place the emergency funds in liquid, short-term floating or short-term funds, the safest funds. Then register, almost all mutual funds have this facility, register a capital appreciation transfer to either a well-diversified equity fund or an index fund. What is capital appreciation transfer? You have got 5 lakhs in an emergency fund. Let's say 8% is the rough current yield that you get. So 40,000 a year. After the first month, it may be some 3 or 3,500. Your 5 lakhs would read about 5.03 or 5.04 lakhs. Keep the 5 lakhs as it is. The appreciation, transfer it to equity. And this you need not do. There are automatic processes. Most of the leading funds have what is called a capital appreciation transfer. Most people are not aware of this. Ask your mutual fund whether you can do this automatically. What happens here? You see, in life, Murphy's law works. If you are not prepared for an emergency will occur. If you are prepared for an emergency, your emergency fund is sitting there, ready to be used. Many times emergencies do not occur for years together. At that time, of course, it will be foolish for the money to continue languishing there. So what you do is keep the money in the liquid fund, the basic principle. Let the appreciation go to equity. Let that get the equity rate. Many times in 5, 6, 7 years, if emergencies don't occur, even the rate of return on your emergency fund will look pretty good. So this is the best ever strategy for an emergency fund. You have the mental peace that if my emergency fund is 5 lakhs, the 5 lakhs is always there for me to use. That is not depleting. Only the income on it is going to equity. And when you look at the emergency fund, please note that your emergency fund is not only the 5 lakhs. It is the 5 lakhs plus whatever is also in the equity fund. So it grows. It grows. This is simply the best strategy for an emergency fund. And coming back to my initial theme, you do this, you see the kind of empowerment, see the kind of power in your hands. You have kept aside some money for investment. The money is very liquid, very safe, available to you at 24 hours notice. The appreciation on that is going to a growth investment. How is it going? Not in one shot. Every month, like a recurring investment, like a systematic investment. You are meeting so many objectives with such great comfort. Let the markets go to 20,000, let them fall to 10,000. It does not concern you. Only your appreciation is being played around there with the market, not your principal. William Bernstein is one of the world's leading authors today on asset allocation. And he is very clear about recommending mutual funds, especially debt funds. He says, when you go into debt funds, debt means safety. Do not take risk in debt funds. You take risk in debt funds by going for long-term debt funds, 10 years, 15-year debt funds. where if interest rates change, you could have a loss to principal even in a debt fund. So William Bernstein is telling us, stick to short-term debt funds. The same three I told you. In the Indian context, it would mean liquid funds, short-term floating rate funds, at the most short-term funds. So William Bernstein's dictum, always remember, you want to take risk, take it in real estate, take it in equity. Do not take it in debt. Let debt remain safe. Let there be something that is never going down. Second area where I see value, intermediate term investment. Now, what do I mean by intermediate term investment? For me, short term means anything less than 1 year. This audience may not laugh at me, but anywhere else they would have laughed at me. Because today, long term means when the Bombay Stock Exchange and National Stock Exchange open at 9 o'clock, and if you are buying at 9 o'clock and you are selling at 3 o'clock, it is long term. Intermediate term means if I buy when I'm having breakfast and I sell when I'm having lunch. Short term means if I buy at 9:15 and sell at 9:16. For me, anything less than 1 year is not even investment. It is parking. It's very important to understand this difference. I don't watch the TV screens, but somebody told me once how a question was being asked on, I think, CNBC. Should I buy this share? And the expert who was sitting there was replying, for that you must tell me whether you are a short-term investor or a long-term investor. And the investor replied, I'm a very long-term investor. I can invest for 3 months. Intermediate term investment is more than 1 year, less than 5 years. Why 5 years? Because 5 years is the minimum time horizon for equity investments, according to me, and according to the average boom and recession cycles that we have seen in world stock markets in the 400-year history of world stock markets. So when we look at intermediate term investments, we learn how to use debt funds effectively. I do not know when I need my money. Liquid funds. I know I do not need my money for 3 months, but after that I do not know when I need my money. Probably I need it within 1 year. Go for something like short-term floating rate funds. 1 to 3 years. Fixed maturity plans are fine, provided they are more than 1 year and anywhere less than 3 years. Short-term funds are also fine. And if you need to go between 3 and 5 years, you can add a little touch of equity, 10%, 20%. You've got something like monthly income plans, a very poorly named product. All it means is a huge commitment to debt and a very small commitment to equity. There are some asset allocation rebalancing plans where maybe 80% is debt, 20% is equity, rebalanced every 6 months or so. Any of those plans may be fine. But even for equity to make an entry, it should be at least 3 years. I would prefer 5 years. But this would be a reasonably good strategy to use debt funds. You can use them for emergency fund. You can use them for intermediate term investments. These are not the only avenues of investment for intermediate term. Bank deposits, government bonds may be fine. It all depends from time to time what the situation of the debt market is going to be. Also, where you stand in income tax. Because here, if your intermediate term is after 1 year, the maximum tax that can ever fall on you is only 10%. It's long-term capital gain. Whereas bank deposit will continue to remain 30% if you are in the 30% bracket. Like I said, calculate your post-tax rate. Then take a decision. John Bogle puts things in beautiful perspective. Let us listen to what he's saying. This is a beautiful passage. Irrespective of what the future holds, it seems to me that equities should remain the investment of choice for the long-term investor. The dominant component of a well-balanced asset allocation program. Let us pause just here for a minute. What is he saying? Let anybody say anything. the world is coming to an end, capitalism is dead. Worse things have been said before, worse situations have been encountered before. But John Bogle is saying, irrespective of what the future holds, it seems to me that equities should remain the investment of choice for the long-term investor, the dominant component of a well-balanced asset allocation program. He's not saying put all your money in equity. But if you're a long-term investor, it should be the dominant component. Then come to the second point there. Bonds, this is debt, he's talking about debt, like debt mutual fund. Bonds are best used as a source of regular income and as a moderating influence on a stock portfolio, not as an alternative to stocks. In two simple sentences, he conveys what asset allocation is all about. Long-term investor, mainly equity. Need not be all equity. If it is not all equity, what else do you have? You can have real estate. You can also have bonds. But understand the role of bonds, he says. Bonds are either a source of regular income or a moderating influence on a stock portfolio. William Bernstein has said it beautifully. Even a small quantity of bonds in an equity portfolio reduces risk vastly. The cost-benefit analysis, when you do, works in your favor. A little bit of bonds in your equity portfolio can greatly reduce risk. That is the beauty of as he says, a well-balanced asset allocation program. This is a beautiful saying by John Bogle. Instantly you know how I should invest. For my long term, predominantly in growth assets, I can use bonds a little bit to modify the risk, to moderate the risk. Third area, very important area, systematic investment. Most of the other good mutual funds focus today more and more on systematic investment. From time to time, let me caution you right now, you will find some financial journalist publishing some article in the paper saying that over 10 years, 15 years, lump sum investment has given more returns than systematic investment. There will be these things. And the same fellows will be writing opposite, how systematic has given lump sum investment in another set of period. They miss the entire point. They miss the entire point. If they were experts on investment, they would not be financial journalists. Be very careful about what you see on TV and what you read in the papers, including articles written by so-called experts. Many times they can be totally wrong. There is a saying about financial journalists. There are 4 types of people involved in the stock market. Those who have the money to invest but do not understand the markets are called investors. Those who understand the market but do not have the money to invest are called brokers. Those who have the money to invest and understand the markets are called tycoons. And those who neither understand the market nor have the money to invest are called financial journalists. Systematic investment. Lump sum investment gives better returns than systematic investment. Okay, supposing you don't have a lump sum. Do you have any other choice but to invest systematically? The two things have to be viewed in perspective. If somebody is only a wage earner, has not won a lottery, has not got an inheritance, he better follow this. If you want to moderate risk, this is a good way to invest. Let us understand systematic investment. What is a systematic investment plan? Simply an investment plan by which fixed or varying sums of money are invested in one or more avenues of investment at regular intervals. Fixed or varying sums of money invested in one or more avenues of investment at regular intervals. You see the flexibility here. We are so used to recurring deposits, bang, 2,000 rupees per month. You don't do it, some fine will be there. In one or more avenues of investment, nothing prevents you from having several investments, one in debt, one in equity, one in some asset allocation. You've got a lot of flexibility. But is there one area where there is no flexibility? Yes. That is in the third point, at regular intervals. That is a self-discipline that you must impose on yourself. I'm going to invest every month. I must invest every month. I have an objective of investing 10,000 rupees a month. 1 month I cannot afford 10,000. Fine, drop it down to 5,000, drop it down to 3,000. 1 month I have a surplus. I've got 20,000. Invest. Nobody prevents you from investing. You cannot say, oh, this month I cannot invest. Then it does not become a habit. And just as we can cultivate bad habits, we can also cultivate good habits. And a monthly investment is one of the best habits that you can ever cultivate. This is the definition of a systematic investment plan. I was talking about power, empowering investors. Let me tell you what power you have when you have a systematic investment. Because for too long we have been exposed to bad systematic investments, like your bank and post office recurring deposits, where the rates of return are fixed. Systematic investment was created not for that. Systematic investment was created for investments whose values fluctuate, like the stock market or real estate. That is where you have the power. So let us look at the difference between a normal investment and a systematic investment. A very simple example. Don't be fooled by all the figures there. I am a normal stock market investor. I have identified a company that's quoting at 100 rupees in the stock market. I believe it is good. I buy 100 shares for 100 rupees. I invest 10,000. Unfortunately, I have invested at the very peak of the market. The market falls heavily. This stock falls from 100 to 70. But understand, I'm not a speculator. I'm a good investor. I'm a courageous investor. I say, if I found this stock attractive at 100, I'm happy for this discount. I buy another 100. Now the market goes down and remains down for the next 2 or 3 years. We are into a long recession. And suddenly I find that this stock is quoting 40 rupees. I don't blindly go out and buy. By now I'm getting the balance sheet, annual reports of the company. What I find is, yes, there is a deep economic recession. Company is not making the kind of profits it was making over here. But the company is still making some profits, still paying some dividends. My argument now is, if this company can keep its neck above the water in the bad times, definitely when the markets once again turn, it will be very good. So I buy my third 100 at 40 rupees. And when I do my final accounts, I have bought 300 shares for a total of 21,000 rupees. I am holding 300 shares at 70 rupees per share. This is normal good investment, not normal bad investment. In normal bad investment, somebody would with great fanfare buy here and sell in a panic here. This is good investment. Now let us convert this good investment to systematic investment. In normal investment, an investor's focus is in number of shares. In systematic investment, our focus is not in number of shares. Our focus is in equal monthly installments. You have invested 21,000 here, therefore you must invest 21,000 here. But that 21,000 must be divided into 3 equal parts. That is the only difference. Rest of the example is same. My first 7,000 rupees I invest when the rate is 100 rupees. Whatever shares I can get for 7,000 rupees, I can get 70 shares. My second installment, I invest just like this. When it is 70 rupees, I get 100 rupees, 100 shares. And my third, I invest when the rate is 40, I get 175 shares. Now if I do my final accounts, I get 345 shares here, not 300. And I'm holding these shares at something like 61 rupees per share, not at 70. No magic, simple mathematics. The difference between this and this is, here you are buying the same quantities. This is what investors do. We get obsessed, fixated with quantities, nice round numbers. We must begin to love fractions. Here, when the markets are high, you are buying a lower quantity. When the markets are low, you are buying a higher quantity. And without your knowing it, here you are getting a simple average. Here you are getting a weighted average. In any systematic investment plan, you will find that the cost, your actual cost, is lower than the average cost. Try it. If any of you are in systematic investment, take a 2-3 year period. Take the highest NAV, take the lowest NAV. Add the two, divide by 2, you get the simple average. Then take the total number of units that you have obtained and the total money you have put there. Obtain your actual weighted average. You will find that this figure will always be less than this figure. Now do you understand what I mean by investor empowerment? By doing nothing, by just following a disciplined pattern of investment, you are investing intelligently. You are making use of the fluctuations in the market to do good to yourself. You are taking advantage, you are exploiting these fluctuations, whereas other people are panicking because of those fluctuations. And now also do you understand what I meant by saying that systematic investment was invented for not fixed rate returns, but for returns that fluctuate. The more you fluctuate, the more the investment values fluctuate, the better your systematic plan. That's why if you take high volatility fund like mid-cap funds, mid-cap funds, I would say the rule should be only to invest through a systematic investment plan. Even if you have a lump sum, invest through a systematic transfer plan. Don't go lump sum. Because the volatility is great in those funds. They can fall 80% sometimes. And this works in your favor. Charlie Munger, we have all heard of Warren Buffett. Charlie Munger is his partner for decades. Charlie Munger says, it is the nature of stock markets to go way down from time to time. There's no system to avoid bad markets. You can't do it unless you try to time the market, which is a seriously dumb thing to do. I'll wait for the bottom, I'll wait for the top. No. The top will come, the top will go, you will be waiting. Conservative investment with steady savings, without expecting miracles, is the way to go. A beautiful endorsement here of systematic investment. Conservative investing with steady savings. Steady savings, that is systematic investment. Why systematic investment? Systematic investment and diversification are actually one and the same, but it is so important that we consider it. When we talk about diversification, we generally think of diversification as, okay, in equity, sectors, automobiles, pharmaceuticals, software, and then stocks within those sectors. But there is one more diversification. That is diversification across time. I have got my 36,000 rupees. I want to invest. But if I invest across 36 months, I have diversified across 36 points of time. It is nothing but diversification across time. And when good diversification, like investing in a well-diversified equity fund, is married to diversification across time, you have one of the finest ways of investing. And that is systematic investing. Systematic investment automatically enables right pricing. We saw it. Systematic investment makes investment a habit. Very important to cultivate those habits. There's a beautiful old saying in investment. If you work on an investment, it will work for you. When you work on an investment, you work by ensuring that your systematic investment never stops. No excuses. I was not well, I forgot to renew my SIP, there was no money in my bank when the date came to invest. No excuses can be tolerated. We are so used to the kind of slightly crazy discipline we have in our educational institutions. Somebody imposes rules on us. May or may not be good, but according to me, the only discipline that has real value is self-discipline. I impose on myself a certain discipline because I believe that self-discipline is good for me. That is the kind of self-discipline that we must impose in systematic investment. And good will happen to us. A beautiful way of providing for future financial needs. There's this website called behaviorgap.com run by Carl Richards. With simple diagrams, he conveys good meaning. And when we think of our own future investment needs, very often this is what we think we will need and this is what we actually need. One of the major problems that the people in Simplus and the people like me are grappling with today is retirement planning. So many people are hopelessly unprepared for retirement. You work from the early 20s till the age of 58. Supposing you live from 58 to 88. Please close your eyes for a moment and compare that 58 to 88 with 28 to 58. Look at these two time periods. If you meditate on this one single factor for half an hour, you will immediately take steps to build up reserves for the future. And you can have any notions you like about your future financial needs. The reality will always be far more than the perception. And the only way to build for it is to have a huge surplus for retirement. Burton Malkiel, Princeton professor of economics, author of a book called A Random Walk Down Wall Street, an investment classic, he says this: persistent saving in regular amounts, no matter how small, pays off. These are the best brains in the world. They are not telling you to take your textbooks of mathematics and statistics and finance and start using spreadsheets and calculators. Look at the language. Persistent saving in regular amounts, no matter how small, pays off. What are the two qualities you require for equity investing, including systematic investing? It is cash and courage. Many times when the markets are down, I have the cash, but I don't have the courage. I'll wait for some time. This is the time to invest when things are cheap. You see 50% discount on the shop, you run to the shop, you'll have to wait in a queue to enter the shop. You see 50% discount in the stock market, you can easily enter. There's nobody there, all are gone. Why don't we use our life common sense in our investment? This is a question that never ceases to amaze people like me. The same common sense that we use in life. Something is cheaper, let me buy more. Now in the market, something is cheaper, let me run away. I'll wait for it to be costly, then I'll go and buy. Two requirements for equity investing: cash and courage. Warren Buffett: cash combined with courage in a crisis is priceless, he says. Cash combined with courage in a crisis is priceless. And he practiced what he preached. In November 2008, he invested $15 or $20 billion in the US stock market, where everybody said the world is coming to an end. When you talk about systematic investment into equity mutual funds, let me see if I can give you one or two small pieces of advice to increase your own power, to increase your own returns in systematic investment. Double the original systematic investment if the index drops by more than 25% from its last high. Can you do this? And quadruple the original systematic investment if the index falls by 50% or more from its last high. Let me give you an example. In November, I think 5th of November 2010, we had an index of 21,005 points, 21005 BSE Sensex. 25% below that would be something like 15,754 points. If you have a systematic investment plan of 5,000 rupees running, and you find that the index is below 15,750, why don't you slightly increase your SIP? If you find that the index is something like below 10,000 or 10,500, either dump everything that you have got one shot, that's where you can go for lump sum investment. Or once again, with everything that you have got, hit the market. It requires courage, it also requires cash. There are people who have the courage, they don't have the cash. There are people who sometimes have the cash, they don't have the courage. But if you have both, just doing these two small things can add a rocket fuel to your investment returns. Do not panic. Anytime you feel like panicking, Please understand that in 400 years, stock markets have not closed down. So if they close down tomorrow, an event should occur that has not occurred in 400 years. In that period of 400 years, hundreds of thousands of banks have closed down. Let's understand that. Jason Zweig, one of the finest financial journalists today, I'm sorry, he's a writer more than a journalist. The intelligent investor realizes that stocks become more risky, not less, as their prices rise, and less risky, not more, as their prices fall. This should give you the courage to invest more when the markets are down. The intelligent investor realizes that stocks become more risky, not less, as their prices rise, less risky, not more, as their prices fall. We think that they become more risky when the prices fall. Not true. This is what he's saying. It would be well worth heeding that kind of advice. So when you talk about systematic investment plans and mutual funds, if cash or courage or both are lacking, what do? I gave you how you can increase the efficiency or the efficacy of your own mutual fund investments. But what if you can't do it? I have no cash, I have no courage. Then at least continue the original SIP without interruption, at least for 60 months. And most important, whatever happens, do not panic and cash out at the bottom of the market. If you do this, the very next day after you're given your redemption request, you'll find that there's a boom in the market. Ibbotson Associates is a very high quality research firm in the US. They did a study of what happened to a lump sum investment in September 1929 when we had the Great Depression. Stock prices in the US fell 89%. We had the global financial crisis starting from the second half of 2007, which is the second worst financial crisis ever seen. The Indian stock markets at this time fell about 61%. We are here talking about an 89% fall in 1929 to 1932. And according to this research firm, if you had invested 12,000 rupees in the S&P 500 index at the beginning of September 1929, 10 years later, you would have 7,223 left. You invest 12,000, you wait 10 years, your investment value is only 7,223, lump sum. Now, this 12,000, if you had divided into 120 parts and sent it every month $100, at the end of that same period, you would have 15,571. That's the power of disciplined buying, even in the face of the Great Depression and the worst bear market of all time. Let's see the Indian context. I have taken a mutual fund called the Franklin India Prima. Please note that. Let me clarify, when I mention names here, I don't like to give examples like ABC Limited if you had done it. I like to give an actual example. But understand, it's not that I'm recommending it. The reason why I've taken this is the only mutual fund where I've got nearly 18, 19 years of uninterrupted data. This would work with any diversified mutual fund. In fact, the Prima is a mid-cap fund. It is definitely not my starting point. My starting point would be an index fund or a very well diversified large cap fund. But simply because of the time for which I've got uninterrupted data, here I've taken this example. 1,000 rupee SIP per month, 18 years and 3 months. This is the only reason I've taken this particular example. That's about 2,19,000 is what you would have invested. And today, if you see the value would be 21,82,388. Please note that it is not 2,19,000 invested 18 years and 3 months back that has gone to 21 lakhs and odd. 18 years and 3 months back, you started with 1,000 rupees. After 2 years, it was only 24,000 rupees. But you did not stop. You did not stop. You did not even do the things I told you. Whenever there were recessions in the market, you invested nothing. You just continued this. You got these kind of returns. And 1,000 rupees even 18 years back, something like 1990s, would not be a very great amount for a normal middle class or even slightly lower middle class person to invest in. I'm just trying to demonstrate here the power of sustained investment, Burton Malkiel, persistent savings in regular amounts, no matter how small. This is an example. Warren Buffett says it beautifully. It is not necessary to do extraordinary things to get extraordinary results. See the consistent theme that I'm maintaining throughout this presentation. Simplicity, common sense, empowerment. If I am to give you genuine empowerment today, I tell you it is not your education, not mathematics, not financial wizardry that will give you the returns. It is perseverance and persistence. Perseverance and persistence. You don't have to do extraordinary things to get extraordinary results. A winner is not one who never fails, but one who never quits. You do your systematic investment, there are no guarantees. Your asset values will sometimes dip below your investment values. I invested for 3 years 36,000 rupees, but it is reading 30,000 rupees. Maybe. So what? What is your vision? Where are you reaching? Are you going to quit? You may fail, but you will know whether you are an ultimate failure or success only when you actually have to redeem your investment. And if that period is going to be 15, 20, 25 years down the line, you have nothing to worry. In fact, if I am a systematic investor, I will be happy when my investment values show minus, minus, minus for a long time. You know why? Then I know that I am buying the next installment at very cheap rates. If I consistently see profits from day one, I would not be happy. I would not be happy. This is the single most important slide in this presentation. John Bogle, stay the course. No matter what happens, stick to your investment program. I've said stay the course 1,000 times and I meant it every time. It is the most important single piece of investment wisdom I can give you. It is the most important single piece of investment wisdom I can give you. What is this most important single piece of investment wisdom? Stay the course. So when your investment advisors tell you, do not stop your plan, continue your plan, understand that they are not inventing this kind of advice. They are taking it from some of the greatest authorities on investing. Fourth area, once again coming back to my theme of enhancing investor power, one or two small pieces of advice here. The stock market is such a conundrum for so many people. It's a puzzle. It's something that creates fear. John Bogle said it in an earlier slide. If you're a long-term investor, equity must be the dominant part of a well-balanced asset allocation program. Nick Murray, who's a financial advisor, says that the great long-term risk of stocks is not owning them. In the short term, yes, things can go up and down. But in the long term, there is no risk in stocks. The risk is not in being a stock market investor, in not having equity as part of your stock market. Why I have put this under investor empowerment is very simple. Mutual funds give you or provide you with a simple and effective way to invest in stocks. They give you a number of techniques. Systematic investment is only one of them. They enable you to invest in stocks without fear, without anxiety. I'll come to that a little later. Let us look at the stock market. On the 1st of April 1979, the Sensex started getting calculated. When it closed the other day, Friday, it was 17,637 points. The compounded annualized growth rate, 17.01%. 17% compounded annualized returns have been given to you in these 33 years. And let us contrast this with Our current favorite investment, gold. In 1950, it was also 100. In 2012, it's some 28,000. And these are your returns. Timothy Green, I think, a bullion expert, he says, the great historical truth about bullion investment is that in the long run, it may preserve the value of your money. It will not enhance the value of your money. Don't be fooled by short-term spurts in gold prices. There have also been 15-20 years where they have performed under inflation. But the long-term returns on gold will roughly equal inflation. Actually, the real consumer price inflation in this country has been around 9.5% over the last 60 years. Yes, this graph is skewed. One shows 60 years, one shows 32 years. So we'll correct it here in this graph. This is the same. And even if you take gold from 1979 till today, even that 10.87% is simply because of the last few years here where the gold prices have been very high. Understand that gold prices are still very close to their all-time peak. Equity prices are a little away from their all-time peak. Now you understand what Nick Murray says when he says that the great long-term risk in equity investment is not owning equity. As an investor, mutual funds empower you by giving you a lot of choices. You have index funds. And I'm talking so much about index funds because as we go along in this country, you're going to see that slowly and steadily, diversified equity funds, actively managed equity funds will find it more and more difficult to outperform the index. Simple statistic, 80% of the large cap actively managed funds in the United States underperform the S&P 500 in a period of 20 years or so. Let's understand this. 80% underperform because of higher costs, churning, etc. That is why in the United States, the shift is more and more towards indexing. Now, Indian stock markets are still not that efficient. But as we move towards the path of efficiency, and we very definitely are moving on the path of efficiency, you'll find that slowly the returns on actively managed diversified funds are going to fall. Therefore, right now would be a good time to balance your equity investments between passively managed and actively managed funds. A little bit of index funds, a little bit of equity funds. You have diversified equity funds. So long as they are diversified, they are fine. You have balanced funds if you want a lower risk level. You have asset allocation funds, one or two funds that are good. Real estate funds we do not have yet in India. I'll put this on the screen. Someday they may come. In the US, they are a very good way of investing. In fact, the systematic investors in REITs, as they are called, REITs, Real Estate Investment Trusts is the name for them in the US. Systematic investors in REIT mutual funds there, REITs, they had the advantage of, from 2007 to 2009, huge fall in real estate prices in the United States. This whole global financial crisis was built upon what we call subprime lending, poor quality housing loans in short. And that drove the real estate prices down and the REIT prices crashed. And the systematic investors who didn't stop investing were able to get REIT fund units at very, very cheap prices. And now many of them say we are making profits. While other real estate investors are still crying, the prices of real estate in the US have gone up slightly. And they are happy with their programs, those who didn't stop those programs. So when they come, real estate funds would be a good option. And then mutual funds give you these techniques of systematic investment and systematic transfer plans that help you to build good investment strategies. There is also this thing of tax saving. The ELSS, equity linked saving schemes, were a wonderful way of saving tax as well as building up long-term growth funds. Future is uncertain. There's the direct taxes code. Every year they threaten to implement it. Every year the government itself is threatened in its existence. So we do not know if and when they will implement the DTC, but when they implement the DTC, please consult your advisors. Please consult your advisors, because we will have to see when the DTC is ultimately implemented, whether ELSS will still continue to be there or not is a question mark. PPF will continue to be there, Public Provident Fund. And when in doubt, open a PPF account and invest. It's a superb investment. There's no doubt about that. So moving ahead, systematic investment through mutual funds enables even very small investors to participate in equity investments. The power of systematic investment can be comprehended when you consider an investment in a total stock market index fund. In the United States, they have total stock market index funds. Fidelity, Spartan, total market index fund. With $100, $500, $1,000, you invest in the entire stock market. The closest we have come to that in India is a fund by Benchmark Mutual Fund, which has now been taken over by Goldman Sachs Mutual Fund. It is Goldman Sachs S&P CNX 500 fund. This fund in India tracks the NSE 500 index. Once again, from the power of, from the point of view of investor empowerment, if you are a very small investor with 1,000 rupees SIP per month, you can straight away buy the 500 top companies in India. And you can continue doing this with your 1,000 rupees every month. In our office, we are proud of the fact that we have about half a dozen rickshaw drivers who have got SIPs. Now do you understand the meaning of investor empowerment? If these people who can afford hardly 1,000 rupees a month were to open demat accounts and purchase the top 500 companies in India, even one share, would this have been possible on a monthly basis? But the mutual fund route gives you this power in your hands. That's why we must be aware of the power that we have. With 1,000 rupees a month, I invest and then keep investing in virtually the entire Indian stock market. So we must look for good products like this. Even in a diversified fund, you get the opportunity to invest in at least 50, 60 stocks every month with a small amount. This is tremendous power in your hands. Systematic investment is good for people with regular fund flows, salary, rent, even profits from well-established businesses. It's good for people with no ready investment corpus, but it requires a higher discipline than STP, that is systematic transfer plan investing or lump sum investing. Unfortunately, when we come to that last point there, we see many times systematic investment plans failing. People forget to renew the plans, people forget to keep money there in the account. Let this not happen to you. So once again we come back. I'm sorry for being repetitive, but I believe in repeating what is important. The single most important slide in this presentation. Stay the course. No matter what happens, stick to your investment program. I've said stay the course 1,000 times and I meant it every time. It is the most important single piece of investment wisdom I can give you. I now come to an equally important area. Fearless investing, I call it. And this is one area of which I'm genuinely proud, because this is one concept we virtually invented. For me, there is no difference between a government bond, a bank deposit, and an equity portfolio. I'm equally comfortable with everything. I would like all of you to reach that stage. There is a simple way that you can reach that stage. Take the fear out of investment in risky investments, in risky avenues. Throughout my career, I used to keep on thinking, there are such a large number of investors who desperately need equity investments to provide for their old age, etc., but who do not want to come anywhere close to the stock market. Why? There is risk there. We are afraid of risk. So I used to always consider and ask myself, can we remove risk from equity investment? Is it possible? And the answer was no. Until somewhere in the 1990s, I was in the Bombay Stock Exchange archives. I had taken permission and was going there and going through the archives. And I found a study. Why it was buried there, I don't know. Generally, all good things are buried somewhere. It's only the rubbish that we see on TV and in the hoardings and the advertising. Buried there was a research report that said that if you had taken 1,20,000 rupees, put it into something safe giving you only 5% return, and 1,000 rupees a month went to the BSE Sensex stocks, there could never be a risk to your capital. I'll explain this by the form of a stunning example. What it meant was, yes, if you go only to equity, there is no way you can reduce your risk or avoid risk. But if you consider an asset allocation program, you can eliminate risk. Let us see whether this can be done. When we look at risk, we think risk is I've invested 1 lakh, it has now become 80,000, that is risk. That is not risk. You read all the top authors, they will say that risk is what the investor does in the market, or for that matter, what the investor does not do sometimes. It is not the stock market. It is the business of the stock market to jump up and down, sometimes for no apparent reason. If it stops jumping up and down, it is not the stock market. Risk comes from not knowing what you are doing. Risk comes from ignorance. And this is what the world's greatest investor is saying. Jason Zweig puts this beautifully. He tells you, do you want to see what risk is? He said, ultimately, financial risk resides not in what kind of investments you have, but in what kind of investor you are. If you want to know what risk really is, go to the nearest bathroom and step up to the mirror. That is risk, gazing back at you from the glass. You are risk, not the stock market, not the mutual fund, not the bank deposit, not the government bond. You are risk. It is what I do in the market that is risky or safe. It is not the market. So you can actually see risk the next time you go to your mirror. Frank Netti says this: remember what is more important than your income. It is your principle. The tree is your principle, the income is your fruit. What is the lesson here? Protect the tree. You cut down the tree, you will not get the fruit. This is the most important lesson that we must learn in investment, including in risky investments. Try to build the maximum risk protection possible. So, let me present to you this simple plan called the Zero Risk Systematic Transfer Plan using mutual funds. I've taken a simple example of 1 lakh. Take your 1 lakh, put it in the safest mutual fund avenues possible. Liquid funds, short-term funds. From here, 1% of the original corpus, 1% of the original corpus, in this case 1,000 per month, to a diversified equity fund or an index fund tracking the NSE 50 index. There will be no risk to your capital at any point of time regardless of stock market conditions. I'll prove this a little later. The STP must be doubled or quadrupled when the market falls by more than 25% or 50% from its previous peak. This you can do. You can expect excellent returns in a period of 5 to 10 years. To understand this, 100,000, 1,000 goes per month. It's like an hourglass. Slowly the sand from the upper chamber goes down to the lower chamber. And instead of trying to explain this, let me actually give you an example that happened to an actual investor from my office. This person was a businessman, very good businessman, but very afraid of risk in investment. In his business, all business has risk, and he was successful. And why I have taken his example is, he happened to invest on the 8th of January 2008 when the index was 20,873 points. right at the peak of the global financial crisis. From the next day, the market was down. It went all the way down to 8,168 points. It fell 61%. You could not get a better date to see whether this zero risk remains zero risk or not. On 8th January 2008, an investor invested rupees 4 lakhs in a zero risk STP involving Franklin Templeton Mutual Fund. Same thing would have happened in any other mutual fund following this strategy. Rupees 4 lakhs was placed in the Templeton Floating Rate Income Fund, a safe debt fund. 4 systematic transfers of 1,000 rupees each were registered to Franklin India Blue Chip Fund, which is a diversified large cap fund. Franklin India Index Fund Nifty Plan, it tracks the Nifty Index. Franklin India Prima Plus Fund, it has got a good deal of mid caps there. And the Templeton India Equity Income Fund, slightly a different character because 20 to 50% of these stocks can be in foreign stocks. It is just to enhance the diversification. So 4 lakhs to be zero risk, only 4,000 per month must go from debt to equity. Are you following me? Okay, very important that you follow me. Please interrupt me if you are not following this, because this is one of the most important examples I can ever give you once and for all to remove the fear of risk from equity investments. So we have got 4 lakhs, 4,000 must go. 4,000 could have gone to just one fund, fine. But we try to improve a little bit of diversification, that's all. Therefore 4 into 1,000. But the principle is the same, 1% is going. The investment values on 9th March 2010, when the BSE Sensex was 8,160. We invested when it was 20,870, were as follows. In the floating rate fund, you had invested 4 lakhs, 44,000 had gone to equity in this period, and that value was 3,85,714. It has nothing to do with equity, it's a debt fund. The Nifty Index Fund, 14 months, 14,000 had gone, the value was 9,891. Blue Chip, you can see what the values were, how much had gone, what the values were, Prima Plus and the equity income. And now when you totaled it, your 4 lakh investment was 4,22,643 in a time when the index had fallen by 61%. If you think I am impressed by this, I am utterly unimpressed. I cannot think of lousier returns. SB account interest rate is what you have got. You may be impressed, I am not. 22,000 rupees on 4 lakh in 14 months. But now, if we want to make it a little impressive, before I proceed, let me point out only one thing here. Each of these is like an SIP. And in this period, from here to here, when the values fell, we had a 61% fall in the stock market. Before I proceed, I want to just point out one thing. If you take your calculators and calculate these losses, you will get something between 29% and 35%. Okay, so even understand that if you had a simple SIP running during this period, you would not have lost 61%. That's the market fall. You would have lost much less. That is one interesting thing to point out. But we are now talking about the systematic transfer plan. So let me go down. Value of a 4 lakh zero risk STP investment after a fall of almost 61% in the market was 4,22,643. What would have happened if you had invested lump sum in an index fund which was equal to the market? This is what would have happened to you. Your 4 lakh would have been 1,56,360. $4 lakhs going to 4,22,000 in 14 months, unimpressive. But better than 4 lakhs going to 1,56,000 in the same period. Some of the so-called seasoned investors have panicked in this time. They said, oh, 1,56,000, let us redeem it now. Otherwise 156 may go to zero. They have forgotten that in 400 years, indices have not gone to zero. At least diversified portfolio of stocks have not gone to zero. Single stocks might have gone to zero. Once again, investor empowerment. I had choices. I could have done this. I could have done this. If I think I'm likely to be afraid, don't try to calculate how risk averse you are. What is my risk appetite? All that nonsense, don't calculate. You will never be able to calculate by answering some questions in a questionnaire. There are questionnaires that are supposed to magically disclose to you your own levels of courage. I have seen commandos of the Indian Army who will be airlifted and put into an enemy country during war, and they will go there and fight and die. But they will panic when their investment portfolio goes from 1 lakh to 95,000. No questionnaires can tell them how courageous they are. Courage in life has nothing to do with courage in investment. You will know when risk occurs. You will know, not the questionnaire will not tell you. You will know. That's why Jason Zweig said, go to the bathroom mirror and look at yourself. That is risk. So it is so important to be fearless. Here, what could the investor do? He could only grumble. 14 months, you have given me SB account interest. Fine. In fact, this investor came to my office, and when I showed him this, he was scratching his chin, and he left my office with one of the great tributes that I have received throughout my career. You know what his comment was? He said, are you telling me that if I cash my portfolio now, I'm going to get 4,22,000 because everybody has been telling him that the market is gone? I said, yes, you're going to get this. And then he says, then what is this global financial crisis that everybody is talking about? One of the Indians in the international scene we can be genuinely proud of is Dr. Raghuram G. Rajan, Booth School of Business, I think Chicago University, one of the finest economists today. Not taking risks one doesn't understand is often the best form of risk management. Not taking risks one doesn't understand is often the best form of risk management. I don't understand a lot of things. I don't understand risk levels. Can I play safe? Can I play safe? John Bogle quotes in his book Common Sense on Mutual Funds a Prussian general, Karl von Clausewitz, who says, the greatest enemy of a good plan is the dream of a perfect plan. If you ask me whether the zero risk STP is the greatest plan ever invented, I'll be the first to tell you no, it isn't. It is only a plan that makes you comfortable. But sometimes making you comfortable may be very important. And you have a good plan, stick to that plan. Don't dream of a perfect plan. The greatest enemy of a good plan is the dream of a perfect plan. Many times, perfect plans will be shown to be far less than perfect. Peter Lynch says, the key to making money in stocks is not to get scared out of them. You see the emphasis that is laid on safety. George Soros, if investing is entertaining, if you're having fun, you're probably not making any money. Good investing is boring. When I show this to you on the screen, the zero risk thing looks very attractive. In actual time, month by month, when 1% is going, it does not look exciting. It looks boring. When your investment advisors are telling you, suggesting strategies that look boring, be happy, they are good advisors. If you are looking for excitement, try adventure sports. Don't do it in investment. Good investing is boring, and George Soros, I put this deliberately because he is one of the biggest speculators in the world. But he's giving the right advice to investors. That's the greatness of the man. Good investment is boring. People have bought property 30 years back in Bangalore. They have held it. Can you think of a more boring thing than buying something and holding it for 30 years? But now, take the purchase price and take the current value. There the boredom ends. Good investment is boring. John Bogle, the key to fund selection is to focus not on future return which the investor cannot control, but on risk, cost and time, all of which the investor can control. In life, in investment, we must understand our limitations. There are areas over which we have no control. There are areas where we have control. It is enough if we focus upon the areas where we have control and which are important. Once again, from Carl Richards, a beautiful slide. Things that matter, things you can control. What you should focus on is things that matter and things which we can control. It may be a very small portion, but if you exercise that control, that's enough. Never worry about whether the market is going up or down. Why? I cannot control the vagaries of the market. I can control my behavior in the market. I can control the strategy that I choose in the market. In fact, there's a whole science dedicated to investor psychology called behavioral economics or behavioral finance. Just one slide on that. Psychology plays an important role in investment. A good investment advisor must be something of a psychologist and counselor. The good investment advisor must realize that if I cannot judge somebody, let me not put him or exhibit him or expose him to risk. Understanding an investor's needs and fears and addressing them is important. A classic application of behavioral finance in personal investment is the zero risk STP. Fearless investing just removes the fear of investing from you. The strategy understands the difference between willingness to take risk and ability to take risk. Many times an investor sits before me. I want to invest in shares. I said, okay, do you know the shares are risky? Yes. What will happen if your portfolio goes down? No problem, I can take risk. How much can you take? I can take 50%. So if my 10 lakh portfolio reads 5 lakhs, I'm not going to be worried. Do you think I'm going to believe him? No. People who grandly sit before me and say, I'm not bothered about a 50% loss. They will be the first to phone me when there's a 5% loss, not 50% loss. 5% loss. If I, on the other hand, see after the markets have fallen 50%, an investor comes to the office and says, is it true that the index is 50% below its last peak? I say yes. Isn't this a good time to buy? I say yes. Buy stocks. After that, I will never advise that investor. He has displayed to me his ability to take risk. And understand one thing, we will never know our ability to take risk in advance. Never. You can take psychological tests, you can take aptitude tests, you can take risk profiling tests. You will know your ability to take risk only when risk occurs. Never before that. Never before that. You must also understand the difference between a risk to capital and a risk to return. If in that period I told you 4 lakhs becoming 4,22,000, if that investor had invested in a bank fixed deposit, they probably got 8% instead of some 3% that they got return there. That is a risk to return. Nobody is afraid of a risk to return. My 4 lakh becomes 3,99,000, my heartbeat rate changes. You must understand the difference there. And this is a superb saying from John Kenneth Galbraith, not so much for investors, but for investment advisors and my friends from the mutual funds here today. Understand what he's saying. All of the great leaders have had one characteristic in common. It was the willingness to confront unequivocally the major anxiety of their people in their time. This and not much else is the essence of leadership. If somebody is a financial advisor, if somebody is a fund manager, if somebody is an investment counselor, she or he is a leader, has to be a leader. Some leadership position must be assumed. And J.K. Galbraith is saying, all of these leaders have had one characteristic, and what is that characteristic? The middle point there, the willingness to confront unequivocally, without hesitating, unhesitatingly, the major anxiety of their people in their time. Believe me, ladies and gentlemen, in 27 years, the major anxiety of investors is only risk, nothing else. I have not seen any anxiety more major than the anxiety about risk. So if your investment advisors are talking to you about risk, talking to you about risk management, please listen to them. They know what they are talking about. The opposite is what Warren Buffett said. Risk comes from not knowing what you are doing. And even the third point there, this and not much else is the essence of leadership. And to conclude this, my all-time favorite saying, Warren Buffett, the first rule of investment is do not lose. And the second rule is do not forget the first rule. And that's all the rules there are. So the world's greatest investor see the kind of emphasis placed on safety. The last area, real estate mutual funds, asset allocation plans. There are few of these. When real estate mutual funds come to India, that will be one way of investing in real estate without committing large amounts of money. I'm just putting them here. Today there are no real estate mutual funds in India. When they come, don't blindly invest in them. You're already in good hands. Consult your advisors. They will tell you which fund is worth it and which strategy to pursue. But it is good to know that real estate also gives approximately the same returns as equity. On an average, it's very difficult to calculate real estate returns because each piece of real estate is different. Forget about different cities and states. Two pieces of real estate on the same road in the same city may have different features. Very difficult. So, believe me, there's no way I can substantiate that. But in India, some of the good real estate advisors have told me that roughly in the last 3 decades, we have had about 175 times appreciation. There may be some pieces of real estate that have really gone not 175, maybe 1,000 times. Others have got stuck because of some reason. But on the average, even in the United States, the early information coming from research tells us that roughly in the long run, real estate and equity give the same kind of return. So these are the only two investment avenues to be considered for growth investments. So when they come, this could be a good avenue. Until then, if you have the resources to directly invest in real estate, please go ahead, no problem. John Bogle, as insurance against the possibility of short or long-term weakness in stocks, therefore, long-term investors should also include bonds in their portfolio. The result is a balanced investing program. Irrespective of what the future holds, however, it seems to me that equities should remain the investment of choice for the long-term investor, the dominant component of a well-balanced asset allocation program. I'm repeating this slide just to introduce the next concept. Bonds are best used as a source of regular income and as a moderating influence on a stock portfolio, not as an alternative to stocks. Where asset allocation is concerned, I've come across some real myths in asset allocation. Asset allocation is like allocation between bonds, stocks, real estate. Let's see what Burton Malkiel is saying. No asset allocation will fit all 30-year-olds, 50-year-olds or 80-year-olds, he says. Because I've come across these wrong type of advice. One of the biggest and most popular wrong pieces of advice is the amount of money that you have in bonds should be equal to your age, the percentage. That means if somebody is 30 years of age, 30% should be in bonds, 70% should be in stocks. And if somebody is 80 years of age, 80% should be in bonds and 20% in stocks. So if you hit 100, you get out of stocks totally. What happens if you're 105? Well, we don't know. But anyway, this is rubbish. This is rubbish. We have a 93-year-old investor in our office. Except a public provident fund account, everything else is in stocks. The dividends that he is receiving are enough to cover his normal expenses by about 4 to 5 times. That means if his expenses are 4 lakhs, he is receiving 16 lakhs of dividends per year. So go back and you can work out what the value of the portfolio is. If somebody comes and tells him, you are 94, how come 100% of your money is in equity? Sell off your whole portfolio. Only 6% should be in equity. He will laugh at them. Burton Malkiel puts the whole thing in perspective when he says, even an 80-year-old might want an asset allocation more suitable for a 30-year-old if she plans to leave most of her estate to her children or grandchildren. The appropriate allocation for those planning bequests should be geared to the age of the recipient, not the age of the donor for that part of their total investments. Apart from some emergency fund and some liquid thing, if you want to pass it on, once again the time horizon is very long. And if those children or grandchildren are trained properly in investment, they in turn will continue to nurture those equity portfolios. That is how the Rockefellers and Kennedys and the families of the US, which have maintained wealth across generations, have not maintained it by following those rules of when you are 90, have 90% in bonds. They have maintained it by investing in stocks, continuing to invest in stocks, and either handing it to certain professional managers or educating their children about how to nurture equity portfolios. That is important. William Bernstein, sticking by your asset allocation policy through thick and thin is much more important than picking the best allocation, because your advisors are more than capable of suggesting to you the right asset allocation plans. So let us conclude this morning. We spent, I hope, a useful morning for you. In our lives, we have got choices. We can take good decisions, we can take bad decisions. If we take bad decisions, the worse the decision, the greater will be our stress levels. I'm trying to make you comfortable. I'm trying to put you in control of your investment life. John Bogle, common sense and simplicity are the keys to financial success. We will end where we started. The opposite of that other slide you saw. If you follow the path of simplicity, the greater the simplicity, the greater the effectiveness of your plan. More than ever in these days of complexity, simplicity underlies the best investment strategies. You see, there's a huge difference between, I find it, because my 27th year in financial advisory, in 1985 when I started, the world was not so fast-paced. And if people can remember, there are some senior citizens here, of what life was, say, in the 1960s or the 1970s. The stress levels, the speed was much less. People were more relaxed. 9-to-5 jobs were much more common than they are now. John Bogle is warning us that complexity is increasing. So he's saying more than ever when complexity is increasing, simplicity should be the foundation of our investment policy. Stick to simplicity. Don't complicate the process. Basic investing is simple. A sensible allocation to stocks, bonds, and cash reserves. Your emergency funds would come somewhere in your cash reserves. Investing for the long term is central to the achievement of optimal returns by investors. To invest with success, you must be a long-term investor. Let's learn the lessons that John Bogle is teaching us. Asset allocation, sensible allocation. For the long term, dominant portion equity. Second, be a long-term investor. If you want to invest with success, you must be a long-term investor. So how do you get the best from mutual funds? Be sure of where your mutual fund investment fits into your overall financial plan. Are you using them for emergency funding, to build up a retirement fund, to build up a general investment fund? Under financial planning, your advisors will tell you, your money should be in 3 categories of investments. To meet emergencies, an emergency fund. To take care of your life in retirement, a retirement fund. The retirement fund is to take care of husband and wife from the date of retirement till end of life of the survivor among them. Let me repeat that. The purpose of a retirement fund is to take care of the couple from the date of retirement to the end of life of the survivor among them. The general investment fund is to take care of all non-normal, non-emergency and non-retirement expenses during active working life. Normal expenses are from normal income. Emergency from emergency fund. Retirement expenses should keep on going into the retirement investments. So what do you use a general investment fund for? You use it for things like children's education, higher education, renovation of a house, down payment of a house, purchase of a vehicle, charity, family vacations. For that you must build up another fund called the general investment fund. And once you do this, then you know exactly where your investments are going. The ultimate objective of investment is to get above average returns at below average risk. That is what I have been trying to tell you today. Slightly try to get higher returns at a lower risk. If you just follow this, the few techniques that I told you today, you will achieve this. And when you achieve this, one day you will come to this level of Warren Buffett. Someone's sitting in the shade today because someone planted a tree many years ago. We have had a long session. I thank you for your attention. I thank the people in Simplus, my good colleagues here who have given me this opportunity to come. They are very much involved with empowering investors, including in educational activities. We hope there will be some more sessions like this at which people can come and actually give you useful knowledge. I also wish each and every one of you a situation like this, if not today, before long, so that all of you will one day without fail become truly empowered, enlightened, successful, liberated investors. Thank you.